Hi.
Welcome to ForexTV.com. Today's Friday, April 3rd. I'm Tim Kelly with your New York Forex Market Buzz. Dollar is higher against the euro and yen and losing ground to the pound and Canadian dollar. U.S. equities are drifting between gains and losses. Oil and gold are lower at mid-session in U.S. trade. Now for a look at the latest headlines. Another 663,000 jobs lost in the U.S. in March. ISM non-manufacturing index weaker than expected, and the Fed's Kohn says more can be done to restore credit flow. The U.S. shed 663,000 jobs in March. That was in line with expectations. U.S. economy shed those jobs in March, making it the fifth month in a row that job losses have been more than 500,000. The unemployment rate rose 0.4 to 8.5%. Economists had forecast a loss of 660,000 jobs in March, while previous months saw 651,000 job losses. The unemployment rate soared up 0.4 to 8.5%. It was actually 8.543 as expected. The loss in total private jobs was 658,000, while the goods producing sector lost 305,000, following 285,000 job losses in the prior month. Private sector slashed 358,000 jobs, while construction fell by 126,000. Manufacturing lost 161,000. The business services sector lost 133,000 jobs, while the financial sector shed 43,000 jobs. The services sector unexpectedly weaker in March. The ISM non-manufacturing index, a key survey of services, construction, and financial industries, moved down to 40.8 in March. That from the 41.6 level recorded in February. The consensus expected the index to climb to 42. Business activity moved up to 44.1 from 40.2, while new orders fell to 38.8 from 40.7. The ISM's employment index came in at 32.3 versus 37.3 level in February, reflecting this morning's dismal 660,000 jobs lost in non-farm payrolls report. This is the 11th straight month of sub-50 levels. Now over to the Fed. The Fed's Kohn says more can be done to restore credit if necessary. The Fed may have to do more to restore the flow of credit. That, according to Fed Vice Chairman Donald Kohn, said the U.S. policymakers and central bankers must remain, quote, very flexible and open to policy actions that had no precedent. Kohn pledging that policymakers would continue to adapt our policies as necessary to accomplish a recovery of the financial system and consequently the broader economy. Nevertheless, many financial sectors remain under considerable stress, according to Kohn, and much has to be done before things return to normal. That was a speech he gave at Worcester College in Ohio. Up north, Canadian-U.S. trade slides in 2008. The U.S. accounted for less than two-thirds of Canada's total merchandise trade in 2008, due primarily to the downturn in American housing and auto markets. That, according to Statistics Canada. On a customs basis, just 65.7% of Canada's trade was done with the U.S. in the year, down from 67.2% in 2007 and 74% in 2003, according to Stats Canada. Canada's annual trade balance with the rest of the world narrowed to $46.7 billion in 2008 from $48 billion in 2007. Exports totaled $489.5 billion during the year, up 5.7% from 2007, while imports rose 6.7% to $442.8 billion. Today we're joined by John Netto, Chief Investment Strategist at Net Black Capital. John, thanks for joining us today.
It's good to be here.
Well, listen, some confounding information coming out post G20, and the jobs report continues to be dismal, in line with expectations, but bad news. And ISM is off. Doesn't really seem to be having too much an effect on the equity markets, as the S&P is just about unchanged. Dow's down a little bit. Why don't we take it from the equity market standpoint? What do you see here? Are we in a bear market rally, or you think we've got some legs here?
I think what the equity markets are showing is that the market is a place where sentiment dictates ultimately. We talk about technicals, we talk about fundamentals, but at the end of the day, when the buyers are control, when there's bullish sentiment out there, they tend to buy. They tend to shrug off bad news and even rally on bad news and definitely rally on good news, as we saw with some of the more upside surprises earlier in the week. Conversely, when we're in a down market or when bearish sentiment is taking control, we tend to see even good news that they can sell into, and bad news really that the market catches the brunt of it. So I think right now it really encapsulates the bullish sentiment that we're seeing out there, and this more or less a flat or unch day that we have right now is indicative that irrespective of the horrible jobs data, that the bulls are kind of in control right now.
Hey John, let's compare that to what's going on in the metals complex and even energy. So take into account this sentiment rally, if as you've described it. Do we infer anything from gold being flat, a little bit off today, but trading flat in the last week and a half?
Sure. Well, gold has been a very enigmatic market to follow and trade. It's been something that myself and my fund are very active in. And it appeared that on the announcement of the quantitative easing by the Fed a couple of weeks back, that would serve as a major catalyst for the metals complex itself to maybe take another leg higher. That has yet to materialize. There were some dynamics that took place last week with options expiration of Thursday of last week, and a week later we've actually seen gold pull back over the course of this week. But you're absolutely right. It's sort of been caught in a range between the 890 and 950 level, which is currently now on the June contract. What I see for gold is probably the overhanging worries about the IMF selling unwillingness to supply to finance these operations, against the backdrop of a couple of major hedge funds out there and world leaders calling for a gold-backed reserve currency, at least with Russia's leader earlier in the week. So I think those two sort of pitting themselves against each other. When it does reconcile itself, we're going to see a big uptick in volatility in the metals market, and it's something that, as a trader, you need to be ready to act on when that does take place. So,
John, looking at employment, that's a lagging indicator. Looking at the stability of the stock market over the last 2 weeks, a little bit of volatility at times, but pretty much holding and gaining ground from week to week. Gold flat to down, and then some bright spots in the economic data, but still pretty bad, but less bad than most had expected. In terms of when we take that picture and then apply it to currencies right now, yesterday we saw that ECB cut less than expected and then gave no information on quantitative easing. That's pretty predictable when it comes to the ECB, and Trichet not exactly doing what the market thinks he's going to do, or perhaps what they've signaled. Now, on that less than expected cut at the ECB, euro ran up a bit. Just a data check right now, 134.36, traded in a range of 133.63 to 134.95. So, pretty big range for euro, but seem a little bit toppish and trading a bit heavy today. What's your thought there?
I think a couple of things with the Euro USD, and something that we want to pay attention to as far as what drives the currency markets, aside from being, is there bullish sentiment in that cross or bearish sentiment, but is it growth expectations or policy expectations that are pushing that market around? With so much information, with so much legislation coming out of Washington, coming out of the heads of government in terms of, or even the central banks, is it going to be, monetary policy? Is there going to be overall country growth in terms of, what that currency represents? And it's determining or ascertaining those drivers that can help traders out when it comes to profiting from those right now. And I mean, I think the euro does feel a little toppish. I wouldn't be surprised to see it's back at 130. The market has a convoluted way of reconciling these things sometimes. I think that there were a lot of hedge funds. It was kind of a crowded short trade. People were expecting some sort of type of announcement of quantitative easing out of the euros, out of the ECB. We didn't get it, and so as fate would have it, we probably, we clean those guys out and then grind ourselves a little bit lower. However, it's also worth noting that there's a major trend line or technical setup on the euro now that if we can hold these levels here and move higher, it wouldn't surprise me to see euro at 141, 142 at the same time as well. But right now, I lean a little bit south, and I won't be surprised to see middle next week to see the euro back at the 130 handle.
Okay, now just a quick data check over on yen. Traders had been expecting this week to see parity. They did. We're trading above parity right now at 100, just over the handle, 104. We were down at 99.33. We touched it, came back, came over. We hit a high of 126. Do we accelerate from here, or is this another seesaw game with yen at this point?
Yeah, it's my trading style to look to buy weakness in bullish markets, and to sell strength in bearish markets. And right now, it appears that the dynamics have backed off. You have a couple of things favoring a long USD JPY position right now. One, there's definitely a greater appetite for risk in the markets, and with that being said, that's been almost a polarizing cross in terms of assessing that overall risk-averse component. Second, the deteriorating fundamentals of the Japanese economy and the inability of them to recover and really react meaningfully to any monetary or fiscal stimulus packages that have been put out there also seems to bode well for that cross and other crosses as well. I mean, you can even look at the Aussie JPY cross as a means of capturing that dynamic. But overall, I mean, I think with the sentiment being bullish on the USD JPY, I would continue to buy weakness in that market, and maybe not necessarily sell strength, but at the very least step back and buy any pullback in that cross.
Okay, and that seems to be had been a good strategy for the last 2 weeks when we came up to parity and then pulled back to the I guess the 94 range about a week and a half, 2 weeks ago.
Right.
So okay, well, let's move off of there, because I think that's a from all intents and purposes, that's been following that game plan, and those who do follow that game plan have benefited. I just want to go over one more, and that is sterling. Sterling seems to be trading almost stealthily upward. Right now, 148, just over the handle, 148.05, had traded as low as 146.46 and as high as 148.45. So about 40 pips off the high right now. But looking at that 150 level, what do you think about that?
I mean, I think the currencies and all the crosses we're talking about, the chance of them breaking out like for major October type of moves or some of the moves we've seen in the past is less likely. So anytime we come across these key levels, there's barrier options or something that we can get into later on, but also play a component at those key psychological levels and what they can do in terms of driving price towards that level. But my initial reaction is to fade the 150 spot, and keep, again, like I talk about, in bullish markets, look to buy weakness, in bearish markets look to sell strength. In this case here, move towards 150, play the move there accordingly. But at the same time, I think pigs get fat and hogs get slaughtered in this market. Bulls can make money, bears can make money, but keep it simple and keep things kind of in front of you and don't get too esoteric.
Gotcha. Now, so just recapping, starting from the currencies moving back, you see range-bound trading. You don't really see any breakouts in any pairs. That's what I'm getting from your last statement. That we'll kind of see this range-bound trading. We start to hit the limits. We might pull off and go back into the range.
Sure.
Gold and the metals complex, specifically gold. You think that we're perhaps poised for a breakout there?
I think that I have a position set up in gold right now that I'm kind of long short-term volatility, and I've set up. I've gone ahead and sold a June 900 put and then bought two May 850 puts for double the amount. And I also have some 1,025 calls that I own in June as well. And so, I mean, just watching this price action and trading gold like I have the last 6 years, this is more of a qualitative play based on the consolidation I'm seeing. That I think the downside risk to gold is more over the next couple of weeks, where the upside potential is more over the next couple of months. And so for me in gold, it won't surprise me if gold even got down to 850 next week, but ultimately I think that it can see 1,000 in the next 52 or 53 days before at least those June options expire. And so the process is a little more fluid than just I think it's going to break out or break down. But I think there's some dynamics, and I kind of want to structure myself to sort of have a piece of all of them. But I definitely have more of a bullish bias over the next 2 months in terms of once we get through some of the overhanging issues, and I think we will, and it becomes evident that these governments are going to race each other to print more and more money, and the underlying longer-term monthly chart, even weekly chart, reemerges itself. We can deal with a major, 3 to 5 week move that sees us tack on $200 to $300. I think that's coming in the next month or so.
And what do you think the trigger is there, John?
But ironically, gold, funny enough, doesn't seem to respond well to major headline catalysts. It kind of just gets ahead of steam, and then people sort of figure out after the fact why it rallied like it did. And I think that's going to be what happens in gold in this case as well.
Okay. Hey, John, I think we're going to leave it there. Really appreciate you joining us on a Friday. Once again, always a pleasure to have you on the show. And I'm going to come back and knock on your door after gold starts to move, and we can discuss that a little bit further.
And that door's always open, my friend. Thanks for having me on the show, buddy.
Yeah. This has been your New York Forex Market Buzz with John Netto of Net Black Capital. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on forextv.com.